All right, welcome back to Follow the Money, friends. Great to have you here. Again, we're joined by my good friend and longtime financial advisor, Mike Mitchell. Mike, it's great to have you here today to talk about finances, personal finances. Great to have you here.
Good to be here, and personal finances are always fun to talk about.
Oh, it's so important. And today we have an interesting topic. We've gotten questions over the years on many different topics. One of the questions we get quite a bit, Mike, is about annuities, because annuities are sold pretty heavily across the country. I mean, it's a pretty interesting concept of what an annuity is. And many people, when they get approached about an annuity, they don't know what to think. And rightfully so, I would say, because sometimes annuities aren't the right solution for a person. So today, what I was hoping is we could just drill down deep into what a fixed indexed annuity is. We have several different annuities we can talk about, but let's begin with the fixed indexed annuity. This is the one we get a lot of questions about here at Follow the Money. Can you talk to us a little bit about, you've been working with these kinds of products for decades. What's a fixed indexed annuity for the average consumer who's out there listening to this? What is a fixed indexed annuity?
Well, first of all, it is an insurance product. That's the first thing people need to know. It's not an investment by any stretch of the imagination. It has some unique aspects to it that I think position it for people who primarily, in our practice at any rate, are really what we consider safe money clients. They have assets that they've accumulated. They want to get some significant or at least better growth than they might get from a CD or even a fixed annuity, which is just an annuity that has a fixed declared interest rate that's declared year to year. But they don't want their money necessarily in the market, in a mutual fund or a managed account that is exposed to a lot of risk. So it's really an annuity, an insurance product that you can have a fixed rate applied to, or you can get an option. I say an option, that sometimes that's misunderstood by a lot of people. It's just simply, it's an opportunity for that contract to participate in the performance of a particular stock index. But people don't need to misconstrue that as it is actual an investment like you would expect it to be relative to having a mutual fund or something of that nature, and have less exposure to risk that you would expect in a variable contract such as a mutual fund or something of that nature.
Yes. And in fact, that's typically the question that people will have, is that they're really interested in the fact that this fixed indexed annuity, when they're approached by a salesman with one, that you cannot lose money, that you're contractually guaranteed. The contractual guarantees mean that the money that you put into the contract, you can't lose. And I think for many people, they think this is a crazy concept in a world of finance where I can't lose. Well, I guess it's similar in that way to a CD, where you have the guarantees made by the bank or the federal government in this case. So it is true that the fixed index annuity is fixed. You're not going to lose anything. But I think the other issue that sometimes people get confused about is that you can't lose, and they're going to get market-like returns year after year. And due to the way these things are structured, they just don't throw off huge market-like returns with zero risk. I mean, there's not even a product on the planet that I can imagine that would give you full exposure to the market and zero risk. That just doesn't exist.
That's correct. And if people have been sold, I know a lot of people are invited to go to seminars, and they're often invited to come to a seminar for a nice dinner, and the presentation is basically get market type returns from a contract that has no risk associated with it at all. It's not quite the way they work. And although the aspect of it being a contract that you contractually cannot lose any money is somewhat accurate, but there could be, depending on the way the contracts are structured, some of the riders that are applied to them or positioned in them, that you could actually see in a negative year where you're tied to the market, that you have some cost factors that could actually dip into your yields, your earnings. So
Mhm.
it's really important to know how the contracts are structured, what's attached to them, to know whether, in fact, you could actually see your account balances go down in a poor performance market environment.
Right, exactly. Yeah, because if you have like 2 down years in a row, for example, then the fixed index annuity, if it's providing you, and I've referred to fixed index annuities like fixed annuities with a call option, with a call option on the stock market somehow. But like the amount of money that's in that annuity that's actually exposed to that call option is fairly low. So you're never really going to receive 20%. If the market goes up, you're not going to get all of that market return. But the attractive part of it is that you, as you mentioned earlier, that principal protection, which is what so many people are after with a volatile market. They just want to put money somewhere and know that it's going to be there when they come back. And if they can get a little growth along the way, hey, why not?
Yeah, and quite honestly, logistically positioning the consideration of a contract like this relative to where you are in your retirement planning. I mean, timing matters. And so consequently, if you find out that you're really kind of focused on coming up on a point in time when you want to think about planning for a retirement picture in your life, and suddenly a lot of your earned assets, your accumulated assets that you've had actually in the market could take a bad hit at the worst possible time. That's where these concepts fit. So protecting accumulated assets, particularly as you're approaching retirement, is a real benefit of these kinds of contracts. But don't go into that consideration thinking, oh, I'm going to get the kind of returns I've expected or I've seen in good years in my variable accounts or my equity based accounts, because all of these contracts have got participation limits, or they've got caps attached to them.
Right.
So you're not going to get all of the upside that you would expect to get with investment type returns.
Let's talk about some of the pros there. So we've talked about the principal protection. That's a huge thing where you put money into the contract and they have these contractual guarantees. Let's talk about what that looks like. So what is the insurance company on the hook for when you have a fixed index annuity? What are the benefits here?
Well, the benefits are certainly tax shelters, tax deferrals. So if you're putting money into an annuity and you're getting positive yields, you do not have to declare those yields as income in the years that they're in that contract. So you got tax deferral. That's one thing. The other thing, obviously, we've already kind of talked about is the protection against market losses. But where a lot of people are misdirected, or maybe even they don't fully understand, and their concepts of annuities are somewhat negative from the perspective that, well, I've heard that you put money in this contract and one day you decide you want to retire, and the company that you placed this contract with promises to pay you out an income. And you take that option, that settlement option, that basically gives all this money over to the insurance company's control for a promise to pay a particular period of time, and something happens, maybe that you didn't get the proper settlement option, and maybe the annuitant died earlier rather than later, and then all of a sudden all this money stays with the insurance company. What a lot of people don't know now is that annuities have been redesigned in ways that can absolutely give them the best of both worlds from the perspective of growth with little risk, and you can structure them in ways that they can pay you an income without the annuitant giving up control of the cash of that contract. So those are some of the real great positives about it. But again, they need to be positioned properly. I know I've heard of some people going into these seminar settings and getting sold on these contracts, and all of a sudden they're putting all of their dollars into these annuity contracts. And so the big issue about that is there's less liquidity in that scenario. So
right.
over positioning money in a contract where you have no liquidity built in can be a problem.
That gets us into the next question, which is there's, some of the cons or some of the negatives about a fixed and by the way, I want to remind the audience today, we're talking just about fixed indexed annuities today. There are many different types of annuities, and we don't have time to talk about all of them today. We're just going to focus on this one today. But when it comes to fixed index annuities, we talked about some of the benefits. I also like the fact, Mike, that most fixed index annuities don't have any fees. There's fees with the riders and the things that you can add on to them, but technically they're pretty low fee kind of vehicles, which is really powerful. But let's move now to the negatives. What are some of the negatives? And you mentioned one, I think that is huge, is that they have these huge, sometimes they can have really long surrender penalties. These surrender charges can be high. So people can't access their money if they need to. They typically have like a 5 or 10% withdrawal that you can do per year, penalty free. But that's certainly one. What are some of the other negatives that people need to be concerned about or know about whenever they're buying a fixed index annuity?
Well, I think that's probably one of the major issues. The other, the lack of liquidity. Typically, most of these contracts are going to have a surrender period that goes for at least 10 years. Some of them significantly longer, and the percentage of charge for completely closing out a contract while it's in its surrender period can be fairly significant. So they need to pay attention to that. One of the other negatives is, again, what we kind of alluded to, and that is you're not going to get as much on the upside as you might be hoping for. So not getting the total upside to that could be problematic. And you have to understand that insurance companies issue these contracts.
Right.
And you need to know
from the wearing very expensive suits.
Yes.
From very expensive buildings. These people aren't giving money away, are they, Mike?
No, they are not. They are not. And so they're you got to realize, the insurance companies need to structure these things in such a way that they can be profitable, and you want your insurance company
course,
to be viable and proper, but you also need to pay attention to the financial strength and financial stability of the company you're considering purchasing these from, because that's what backs your contract. There's no other backing other than the relative financial strength of that insurance company that you're considering. So knowing those factors are pretty important.
That is huge. So let's talk also about the interest rate fluctuations. And someone is looking at a fixed index annuity, and I've heard you say a lot of key words here. You mentioned the importance of being properly structured. That's what we think about when we think about a life insurance contract. Many times people buy a life insurance contract and it's not properly structured, so it doesn't work the way that they had perhaps wanted it to work. It's the same thing here with the annuity. As you mentioned, you've got to do your research. You've got to make sure not only are you using a company or a carrier that is great financial strength, but you also want to make sure that, as you mentioned, that the contract is structured properly for your goals. What are you trying to achieve? So that's very, very important. And that really boils down to making sure that you have an experienced person who has handled these things before and knows what they're doing. So that's really important. But in our final moments here, let's go back to what I was saying earlier, the interest rate fluctuations. Somebody might be, preparing to buy a fixed index annuity, and they're looking at the interest rates and they're wondering, when rates go up, is that good for me? Or is it better when rates go down? Or how do interest rates ultimately affect fixed index annuity strategies?
The insurance companies each year, they're going to buy an option. You mentioned that earlier. And the option is an opportunity to participate in the performance of that particular index that they're going to be tied to. As interest rates go up, what you tend to see is the caps and the participation rates that these contracts offer tend to go up with them. So if you have a rising interest rate environment, your cap rates and your participation rates tend to go up. But there's a little item that a lot of people don't know about. I would say most advisors don't fully understand it, and they rarely explain it. But there's a provision in virtually every annuity contract. There's not very many that doesn't have this, but it's called a market value adjustment. And this is particularly tied to the interest rate environment. So simple little example. Let's just say you've got $100,000 in your accumulated account balance. You're still in your surrender period at some point, and you decide, I need to walk away from this annuity. At that point, the insurance company is going to look at the relative cost of the interest rate environment that they're in, and they're going to adjust that account balance either up or down relative to the interest rate environment. So if we're in a rising interest rate environment, your $100,000 might not be $100,000. It may be something less than that. It's potentially an additional cost that could impact your contract at surrender if you're in the surrender period. Mm-hmm. So that's completely tied to the interest rate environment, along with the fact that interest rates they impact the level of cap rates that an insurance company offers from year to year in your contract, or the participation rates that the insurance company offers. That's all tied to the interest rate environment.
Interesting. Okay. Very, very helpful. And as interest rates are rising, of course, that's good news for most financial institutions. So I would imagine life insurance, very similar. Mm-hmm. They certainly do, and they thrive in times of rising rates. It's good for business. So those who are listening to us today, Mike, they might have, maybe they've been approached by an annuity salesman. Maybe they've had a pitch before where they said, well, this might be a good idea for some of my money. What tips would you give them in our final concluding moments? What should they be thinking about if they're considering an annuity right now? What are some of the things they should immediately be thinking about?
Well, I think first of all, they need to be focused on their risk profile, their risk tolerance. Mm-hmm. They need to be focused on where are they on that time horizon relative to their retirement plans. Mm-hmm. And I think they certainly need to be getting advice from a qualified, experienced advisor that can plug these variables into a comprehensive plan that fits their situation so they can be custom to their issues and their need.
Perfect. Yeah. I mean, there are so many different types of annuities too. There's fixed annuities, there's fixed index annuities. There's, of course, the variable annuity. I mean, there's so many different kinds, and they all have different bells and whistles that you need to know. So you really want an advisor who knows what they're doing and is experienced with those. So that really helps. I really appreciate it. We should do this again on another annuity type and just talk through some of the different annuities. But like I mentioned, we got so many questions over probably the last couple of years, just about fixed index annuities. I know there's been quite a big promotion of those because they do seem to solve some problems that people have, like income for life.
Yeah.
But of course, there's costs too, and you've got to know those as well. Make sure they're right for you. Mike, thank you so much for being here, my friend. I would encourage folks, Mike and I have been working together in this space now for many, many years. And if you are currently considering an annuity and you want a second opinion, or if you're curious and you said, well, I didn't know this kind of product existed and I want to talk to Mike more about it, I would encourage you to reach out to him. Mike, would you provide the folks your contact information and explain to them what to expect when they reach out to you? How does that work?
Yeah. When they call in, my firm is Strategic Wealth Partners. That's the name of my firm. We have an 800 number, toll-free number. It's 833-370-0777. They can call that number, and when they do, they will actually get connected to myself and our firm, and we can we can connect with them and talk with them about their specific situations and get into these areas that we've been talking about today, and help them develop a comprehensive plan that'll fit their needs.
Nice. Okay. Fantastic. Mike, it's always great to have you here. I thank you for your, just the experience that you have and for being willing to share it with our folks. And if folks want to reach out to you, they can give you a call. If they're looking at annuities or life insurance, retirement planning, you cover it all. So great to have you here, Mike. I sure do appreciate it.
Great to be here. Thanks, Jerry.